Hi, and welcome to Fridays with Phil. We're going to call this one the interest rate edition. Received a great question this week, and I thought I'd share it with everybody. The question was, how does the stock market perform in a rising interest rate environment? Um, Many believe that the recent rise in interest rates is a reflection of investors' expectations for a strong recovery. And of course, this is a positive sign as it seems like we are emerging from the worst of the pandemic. By last count, about 15% of Americans have received at least one dose of the vaccine. Um, but of course, some people worry about the unintended consequences to the stock market that may come with rising rates. Our friends at CNBC or any of the other financial news outlets will make the case that rising interest rates lead to higher borrowing costs, increased debt costs, and ultimately make it difficult for businesses to grow. The case can also be made that rising yields reflect investor sentiment for faster growth, which could bring forth a concern about increased inflation. Remember, their job is to peddle fear, thereby driving transactions. That's exactly what old Wall Street wants. More fear, more transactions equals more revenue. That is their business model. So, for the truth on rising interest rates and their effect on the equity markets, I suggest going to the research, something Wall Street does not want you to do. Unlike bond prices, whose price is inversely related to yields, the research shows stock prices might rise or might fall with changes in interest rates. Our partners at Dimensional Funds examine this correlation between monthly U.S. stock returns and changes in interest rates. Their conclusion is that while there is a lot of noise in stock returns, there is no clear pattern between yield changes and subsequent stock returns. For example, in months where the 10-year Treasury rose, stock returns were as low as minus 17% and as high as plus 15%. In months when rates fell, returns ranged from minus 23% to plus 16%. Dimensional also examined the relation between equity prices and short-term interest rates and basically found a similar result. For investors who have a strong belief in the path interest rates will take in the future, the desire to change their equity investment plan should be tempered with the knowledge that even with perfect knowledge of future rate changes, one will not have enough guidance about future stock returns to make investment decisions. Because the future is by definition unpredictable. Instead, we are advising our clients to stay invested and avoid the temptations to make changes based on short-term predictions. Staying the course may increase the likelihood of consistently capturing what the stock market has to offer in any interest rate environment. Please do not let old Wall Street frighten you into making investment decisions. Speak to your advisor. If you do not have one, book a 15-minute chat below and let's see if we can help. Thanks for watching.